How's it going? It's Adam, and today we're talking about cash secured puts. What are cash secured puts? Well, and in essence, they are locking in a price to buy 100 shares at and getting some money for doing so. I mean, that's basically it. There's a little bit more to it than that, but that's the essence of a cash secured put. You're locking in a price by selling a put to buy 100 shares at. Now, if you're already lost, that's okay, because I feel like the learning curve for this strategy starts out a little steep, but then once you get it, like, it's in there. You don't have to constantly be remembering, refiguring out, like, how does this interact with this? Like, once you get it, it's stuck in your head. It'll become very, very easy from that point on. So if you feel like you're struggling right off with a little bit to grasp what a cash secured put is, don't worry. Don't be disheartened. It is totally normal, and there will be a moment where it clicks and you'll understand basically all aspects of this strategy. So I'm going to teach you what a cash secured put is, and then we'll actually trade one on Robinhood so you can see what that's like as well. You ready? All right, let's do it. Got my tablet, my pen. The foundation of understanding cash secured puts revolves around the idea of selling to open. You are probably very familiar with buying to open. That's when you go find a call or a put and you're like, that looks good, I want that. So you pay some money for it. You collect the option, it's in your possession. You no longer have your money, it's out there in the ether. You have that option, and over time you hope that the value of this option rises in the market so that you can sell it back and collect more money than you initially paid. That would be getting a profit for the trade. Selling to open is being the other guy, the guy who sells the option, the guy who sold the option to you in this hypothetical. So when you sell to open, you go to your brokerage platform, whatever that might be, Robinhood, TD Ameritrade, E-Trade, Tastyworks, whatever, and you sell an option that you don't already own. When you sell an option you don't already own, you create an entirely new contract. You are writing an option and you sell it to someone else. So you are providing the option in this case. You're not buying it from someone. You're literally creating it out of thin air and selling it to somebody else. So there's a very simple exchange that occurs when you sell to open an option. Over here on the left is a buyer, and over here on the right is obviously you, the seller. And when you go to sell to open an option, you give the guy a contract, and in this case, it's going to be a put. And in return for that contract, this guy gives you some money. That's as simple as it starts out as. That's it. And this money that you receive is yours. It's yours to keep forever. You can do whatever you want with it. So when you sell a cash secured put, and we'll talk about what cash secured means here in a minute, but when you sell this cash secured put, you are selling to open a put to somebody, and you are collecting some money in return. And that's as simple as it gets when you first sell to open this position. And again, you get that money instantly. It is instantly added to your buying power, and you can withdraw it, you can spend it, you can buy more stocks, you can do whatever you want with it. Now, after this point, after you sold the put, there are a couple possible outcomes, and we are going to run through these possible outcomes by simulating an actual trade. So we're gonna write down some specifications for a specific put. Okay, so let's sell to open this put here, and I've written the put specification. So the current stock price, which is denoted by S sub 0, is 26 for Snap. That's the underlying we're going to be hypothetically trading on today. And K is the strike of 25. P is put premium, which is 50 cents, and the expiration is on the 2nd of October, which is less than a week from now. So when you first sell this put, you're going to go to your brokerage and you're going to find this put option, and you are going to enter a limit sell order. Even though you don't already own it, you're going to enter a limit sell order, which will create an entirely new contract. So you go set a limit order for 50 cents at the mid price, and it fills. So this transaction up here just took place when that order fills. As I'm sure you're well aware, this 50 cents right here, that means $50. 50 cents in premiums terms is 50 cents per share of the 100 shares that the contract controls. So when you see 50 cents in premium, that means $50 in more realistic terms. So like I said, this is as simple as it starts. You sell a put, you get some money in return, that's it. Now things can get a little bit more complicated here as time goes on, but you can enjoy that $50 however you want to. So let's recall that S sub 0 is 26. So the current trading price is right here. And let's also recall that our strike is 25. So our strike is down here. So currently, because the strike price is below the trading price, this option is out of the money. It's out of the money because if the buyer of this option, your counterparty right here, this donut, if he decides to exercise this option, he will be selling 100 shares cheaper than he could than if he just sold them at the current trading price. It's not cost effective. It makes no sense to exercise this put option. Therefore, it is out of the money. So if S sub 0, the current stock price, stays anywhere within this range, our contract, our put option, will be out of the money. And if it stays within that range the entire time, it is guaranteed that at expiration, this option will expire worthless because the counterparty will never have a chance to exercise because it was never in the money at any point. So if they never exercise, if they never have the opportunity to exercise, if the option never gets in the money, then it is guaranteed to expire worthless and nothing happens. you get to keep your 50 bucks and that's it. It's pretty easy. Keeping that 50 bucks is commonly called collecting premium. You sold that option for a credit. A credit is when you receive money, and that is also synonymous with collecting premium. And when you collect that premium and the option expires out of the money, you keep that premium. You never paid it back to anybody. It never goes anywhere. You're going to keep it the whole time if you wanted to. We'll talk about how that might not be the case in certain scenarios, but most of the time you'll keep that money regardless. But when the option expires, nothing else happens. You collect the $50, it expires, that's it. The contract evaporates, it no longer exists. You have no obligations or liabilities. You are done with the trade, and you can open a new cash secured put if you wanted to. So that's one possibility, that it expires out of the money. And in that case, you just keep the 50 bucks, nothing else happens. But let's say S sub 0 drops down and is somewhere in this range. So at that point, if it's below $25, your put is now in the money. Now this is where things get interesting. So you've collected $50, but you also gave the sucker a put who now has the right to exercise that put. And if you remember, when you exercise a put, you are selling 100 shares at the strike price. So when this becomes in the money, it is possible at any point in time that your counterparty exercises their option, selling 100 shares at the strike price. It is more likely that your counterparty will exercise the deeper in the money it is, or the closer to expiration it is. That is because the deeper in the money or the closer to expiration, the less extrinsic value the option has, which means the less the person will give up by exercising. If you don't understand what that means, that's okay. You don't have to understand that the deeper in the money it is and the closer to expiration it is, the more likely the buyer is to exercise. Now, if it expires in the money, it is almost guaranteed that your counterparty is going to exercise. When your counterparty exercises, they sell 100 shares at the strike. And that's why you as the seller are there. You are there to fulfill that right that the buyer has. So when they sell 100 shares at the strike, you have to buy 100 shares at the strike. You're on the other end of the trade. And when that happens, when your counterparty exercises, that means you get assigned. So they exercise, but you get assigned. You are assigned to buy 100 shares at the strike. And this is a totally normal process when you have a cash secured put. It is ultimately at some point going to happen. So it's something you might try to avoid, and we'll talk about that in a minute, but it is something that is probably going to happen to you at some point if you trade cash secured puts frequently. So let's talk about what that looks like. So let's say the stock price changes. It no longer is at 26. Let's say it drops all the way down to 24. And let's say it hovers around 24, and the whole time your buyer is not exercising, but then it hits expiration day. And after close on expiration day, the buyer exercises and you are assigned. So let's talk about what that looks like. So here's your portfolio over here. And the whole time you have this put open, you're going to see that you have the put. So it'll show that you have a short put, and it will say how much the put is worth in the market. So over time, maybe the put increases in value and now it's worth not 50, but 90. Don't worry, this does not affect you right now because you are not buying to close. We'll talk about that here in a minute. But because we are not planning on buying to close in this scenario, you get to keep the $50. So don't worry about this number so much for now, but you will see this in your portfolio for a little bit, changing in value, even though you still get to keep your $50 unless you buy to close this put, which we'll talk about here in a little bit. So you're going to see this put, and then when it gets assigned, this put is going to disappear. And in return, you have to buy 100 shares at the strike price. So you are buying 100 at 25. Which means you are paying a debit of $2,500 for those shares. So you have $2,500 worth of Snap shares. Okay, don't be confused. This is Adam from the future, okay? I'm talking quiet because it's a little later at night. It's not like anyone's sleeping. It just makes me talk quieter, okay? So because assignment can happen at any point in time, Robinhood or whatever brokerage you use is going to hold this money aside as collateral. So however much it costs to buy 100 shares at the strike price is the amount of money that Robinhood's going to take and set aside to ensure that you have the funds to pay for those shares in case you do get assigned. So if the strike is 25, you'll see $2,500 disappear from your buying power. If it were 24, you'd see $2,400 disappear from your buying power, and so on. All right, future Adam is peacing out. See ya. So let's say this is a debit. So if you pay $25 per share for each of those 100 shares, we currently have a profit loss that is unrealized for this position. The profit loss is the difference between the current trading price and where we had to buy the shares at, which is $1 per share. Because our average cost for these shares is 25 and the current trading price is 24, we have a profit and loss of minus $100. But we also have to keep in mind the $50 we initially received, so let's add $50 to our profit and loss. and we are now at a loss of minus $50. So at this point, I would not be surprised if you're bashing your head on your desk going, what is the point of all this? We still ended up at a loss. I'm confused why we even did this to begin with, and that's okay. Like I said, the learning curve is kind of steep, but once you get all the little pieces, it'll click, and I promise it'll make sense. Let's remember the possible outcomes. The first possible outcome was that it expired out of the money. That would be great, because if it expires out of the money, then we get to keep the credit without ever having to buy 100 shares and incur any sort of loss. So that is a distinct possibility and would be a beneficial outcome. However, this outcome, even though we ended with a loss so far, can still be beneficial. There's two reasons why this outcome is not necessarily bad. If we do not mind owning Snap, or if we actually intended to get assigned at some point and own Snap, then we don't mind holding these 100 shares that are in our portfolio. And these 100 shares, if they rise in value, it can very quickly recoup these losses. And this is even better if you were initially intending on owning Snap, because if we were initially intending on owning Snap, remember what S sub 0 was to begin with. It was at $26. If we bought at 26, then our average cost would be $26 per share, which would mean our cost basis, this is what this is called, our cost basis is $2,600. And as the stock price dropped down to 24, we would hit a loss of minus 200. Now this is unrealized, sure, but you see how $50 is a much more advantageous and preferable position to minus $200. So there becomes this two-sided coin to why you might want to sell a cash secured put. The first is just to collect premium, to sell a put in hopes that it doesn't get in the money and doesn't get assigned. And in that case, you just get to keep your premium without ever having to own the underlying shares. Or you intend on owning the underlying, but you want to collect a little bit of a premium first, and so you sell a put to collect some premium, and if you do get assigned, great, you were going to own the shares anyway. But now the average cost for the shares is much cheaper. Hello, how's it going? Hope you're not falling asleep like I am, because this guy, oh man, he's a fucking nerd. Nerd that he may be, I need to correct something he just said, because although it's not entirely incorrect, it's just not very well put. I made it sound like you could choose between just collecting premium or wanting to get assigned and own the underlying. That's not true. If you tried to just collect premium over and over and over again, eventually one day you are going to be assigned. So that said, even if your intention is to collect premium most of the time, trying to avoid assignment, you still have to be okay if you do get assigned. If you sell a cash secured put on some garbage penny stock and then you get assigned and you're not happy holding those shares, you're gonna have to sell them for a loss. It's much better to sell cash secured puts on an underlying that you don't mind owning so that you can recoup those losses we talked about in case you are assigned. That said, you can still try to avoid assignment. It's totally fine if you prefer the premium, but at some point you probably will get assigned, so don't come crying to me if you do. Hope things are going well. How are the kids? Tell Susan I said hi, okay? See ya. So let's go through the two possible outcomes that we briefly mentioned earlier, just to recap here. When you sell a cash secured put, usually you're going to sell it a little bit out of the money to avoid assignment. The goal is to collect as much premium as possible. So you're going to sell it out of the money. Usually you can sell at the money. If you're selling in the money, that's a pretty bullish move. You hope that it becomes out of the money so you don't get assigned. But most of the time it's at the money or a little bit out of the money. And you're hoping to not have to buy to close that position, which we'll get to here in a second. So in this case, if you hold it to expiration and it stays out of the money, you get to keep that premium you initially received and the put expires worthless. It just disappears. So that's one possible outcome. The other possible outcome is that the put becomes in the money and you get assigned having to buy 100 shares at the strike, which is kind of beneficial because if you're intending on owning the underlying anyway, you probably got in at a cheaper price than you would have, as well as received a credit for that premium you sold, for that put option you sold. However, when you're trading cash secured puts, most of the time you're trying to avoid assignment. We would have much rather preferred to have kept that $50 we discussed a minute ago when we sold that put and never had to buy at the strike, because when we bought at the strike, we ended at a loss. Sure, it wasn't that big of a deal because we can just hold the shares and hope that they rise in value, but it would have been much better just to keep that $50 and not have to be assigned. So the goal of selling a cash secured put is to sell puts for premium, collect that premium, and avoid assignment. If assignment does happen, which it will happen, it's okay because we already understand that we are okay with owning the underlying stock and letting it increase in value to recoup any losses. But for this next section that we're going to discuss, let's keep in mind that we are trying to avoid assignment and we're trying to collect as much premium as possible. So let's remember this transaction. Let's say you sell a put to somebody. Okay, it's a little bit out of the money because you're hoping not to get assigned. The further out of the money it is, the less premium you're going to receive because out of the money options are cheaper. However, it's less likely that you're going to get assigned. If you don't really care that you get assigned, like if you get assigned at the current stock price and you're like, that's sweet, I don't really care, I don't mind owning the underlying, then you can sell at the current stock price at the money. And that's plenty good, and you will get plenty of credit for that. However, if you sell an in the money put option, that's kind of a bullish move, because if you get assigned, you're going to end up buying at a more expensive price than the current trading price. So you're going to have to hope that it becomes at the money or it becomes out of the money. So that means that the stock price has to go up to push your option at the money or out of the money. So generally speaking, you won't sell one that is in the money unless you are pretty bullish on the underlying stock. So we sell a put that's a little bit out of the money because we're trying to avoid assignment. Sure, we get a little less premium for it, but we don't want to get assigned anyway. It's just kind of a pain in the butt. So we sell a put, and in return, in this hypothetical, we're going to say we receive $100 for this put. That money is yours. Like I said, you can do whatever you want with it, but we're going to hang on to it for a moment here because we can use that money to help manage our position. And let's keep a running tab of our credits and debits here. So when you receive money, that's a credit. It's going into your account. That $100 is credited to you. So we have a $100 credit so far. Now this number that you see here, this $100, is going to be represented on your brokerage platform when you first open the position. You will see your short put there in your portfolio, and you'll also see this number. This is describing your equity, your money involved in the trade. And in this case, it's negative because you don't have money involved in the trade. You have negative money involved in the trade. The money is in your pocket. Or in other words, in more simpler terms, it's showing what the value of the option is currently. So when you first open this position, you're going to see the value of the option is $1, and it's negative because you don't have money in the trade. You have taken money to enter the trade. The negative is less important than what the value of this number is. So this is what the option is worth currently. Over time, this is going to change. So let's say that the underlying stock drops in value. Well, that increases the value of put options. So you'll see that this number will increase. So this might increase to 150. Have we lost this $100? Nope, we have not. This is just saying that the current price for the put that we sold at the market is $1.50. But let's say, when we initially sold it, it's out of the money. But when it drops down a little bit, it pushes our option in the money. And this is the current value of that option at the market. Well, we could leave it, like we said, we can just let it be in the money. We'll take our $100 and run, and we'll get assigned at some point. And when we get assigned, we'll have an unrealized loss that we hope will be recouped as the stock moves up in value. So we could just do that. We could leave it. We want our $100. We want to go do something with it. We want to go have dinner tonight. Sure, that's totally fine. That's a good outcome. But like I said, let's focus on trying to avoid assignment here because we just want to collect premium. We don't want to end up with an unrealized loss. So one thing you can do to avoid assignment if your put option becomes in the money, especially as it nears expiration, because the closer to expiration it is, the more likely you are to be assigned. The one thing you can do is roll your put. Rolling your put is buying to close your position and then selling to open another position with a lower strike, probably an out of the money strike. So if it becomes in the money and it's worth $1.50 here, we can buy to close this position. Okay, so we're gonna buy to close this here in a second, but we also want to know what option we're gonna sell to open that's later in the future and further out in strike. We have to choose one that's later in the future because ones that are further out in the future, that have a future expiration, are going to have more extrinsic value. If I just choose the same expiration and try to buy to close this position and sell one that's further out of the money, those out of the money options are going to be cheaper than the one I've already sold. So you'll see in a second that won't allow us to collect a credit. That'll be a debit, and we want to avoid that. That doesn't make sense. I'm sorry. It's okay. So let's go ahead and find an option. Let's say these options were 10-2. Okay, so we have our first put that we sold, put 1, and we're going to have a put that we're going to sell out here in a second. So let's say S sub 0 the current stock price is 20, and put 1 has a strike of 21. So this put is in the money. Put 2 out in the future has a strike of 19. So let's say this is a 10-2 expiration, and this is a November 28th expiration. This put is worth $1.50, as we can see from up here. It's become in the money, is now worth $1.50. This put out here, even though it has a lower strike, because of the time value of this option, is worth more. Let's say it's worth $2. So what do we have to do to buy to close our first position? Well, we have to pay whatever that option is worth. So remember, we're keeping track of our credits and debits over here. So we'll buy to close our first put. So we're going to pay $1.50, which is $150. And then we'll sell to open the second put way out here that is now out of the money. So we're trying to avoid assignment, and we'll collect a credit of however much that's worth, which is $2. So let's look at how much money we've gathered from the position so far. We collected $100 for selling this initial put. And then once it became in the money and was worth $150, we bought to close it. So that's this section. We sold here, and then we paid to close the position right here. Then we sold to open a new put that's out of the money to avoid assignment for a higher credit than we had to pay to close our other put. And we received $200 for doing so. So far 100 minus 150 is negative 50, plus 200 makes it a $150 return. So what happened? Well, we initially sold this put for $100, but by rolling out our put and avoiding assignment, we've actually collected more premium. We've collected a total of $150 in premium and avoided the potential for assignment. So rolling your put is avoiding assignment by pushing your put out of the money. Again, sometimes this is not possible, which is why you want to be comfortable with being assigned and be comfortable with owning 100 shares of the underlying stock at the strike price. But this is a great way to avoid assignment and continually collect premium. So when you roll, make sure that you're buying to close for one price and you're selling to open for a higher price. So you're collecting more money than you're paying. That's the critical part of rolling your position. So let's recap everything so far. There's several possible outcomes when you sell to open a cash secured put. The first is you sell the put, you collect your money. That money is yours. You can do whatever you want with it. I promise you can do whatever you want with it. You'll see in your cash balance that it increases by however much you sold that put for. Time goes on, and it expires out of the money. Nothing happens. Your put evaporates. You no longer have any obligations and the trade is over. And you've always had that premium you collected and it's yours to do whatever you want with. So that's the first possible outcome. It's a nice outcome, right? Second possible outcome is you sell your put, you collect some money for selling that put, and time goes on, it becomes in the money, and your counterparty decides to exercise. That means you get assigned. This is more likely the closer it is to expiration and the deeper in the money the option is. When you get assigned, you have to buy 100 shares at the strike price, so you're going to have 100 shares of the underlying in your possession. You're going to have an unrealized profit and loss, which is the difference between the strike price and the current trading price times 100 minus however much you received for the put. So think about it. If you buy 100 shares at 26, but the current trading price is 25, well, you have a $100 loss. But you can also subtract the premium you initially received for selling the put. And this is fine. You're still going to end with an unrealized loss that isn't too bad. And if you trust that the underlying is going to increase in value, it will recoup your losses. The third possibility is you sell to open your cash secured put. You collect some money for doing so. That money is yours. Time goes on, and it becomes in the money at some point. You're a little bit scared that your counterparty is going to exercise and you're going to get assigned, and you don't really want to do that. You much prefer to collect more premium. So to avoid this, you buy to close your put, and then you sell to open a new put in the future with a lower strike. In this case, you make sure that when you buy to close this put, you're selling to open the new put for more money than you paid to buy to close this one. You'll do this as one trade. You'll enter a limit order to buy this put and a limit order to sell this one at the same time, and it will be for a net credit. This is called rolling your position, and you can continually do this as long as you can. Sometimes this may not be possible unless you sell to open a new put way out in the future with a lot of time value, but you might not want to do that because you do have some money locked up as collateral to make sure you can buy 100 shares at the strike price. And if you sell to open a new one way out in the future to make sure that the rolling your put is a net credit, well, you're going to have that money locked up for a long time, and you may not like that. Okay, so those are the three possible outcomes we've discussed so far. The main strategy you should be implementing here is selling to open a cash secured put and trying to roll it as much as possible without pushing it too far out where you have your money locked up for a long time for a small premium. You don't want to do that. But you're trying to roll your strategy and keep rolling it and avoid being assigned. Eventually you will be assigned, and that's okay because you're just going to hold the underlying shares and let it rise in value. In that case, when you do get assigned, we'll talk about selling covered calls against those shares, but that'll be part of a different strategy where we talk about the wheel strategy. Okay, so option 1, expires out of the money, keep the premium. Option 2, get assigned, you have 100 shares at the strike price, you're gonna have an unrealized loss that will be recouped as the shares rise in value. Possibility number 3 is that you roll your position to avoid assignment and collect more premium in doing so. Now we're gonna get to the fourth possible outcome. So let's run through this example again where you sell to open a put, and this guy pays you some money, and in this case, we're going to say it's $100 again. When you buy a put, if you remember, you have a negative theta. As time passes, you lose money. The value of the option is deteriorating. When you sell to open a put, that's good for you. You want this value of this option to deteriorate, because if you sell to open the put for $1 and then buy to close the put for $99, you just made $1 in profit. And this $1 difference may not have been due to the stock price or implied volatility. It might be just due to theta eating away at the value of the option. So if the value of the option decreases, you can buy to close it for a cheaper price. And that's good for your profit and loss. So maybe as time goes on, the value of the option decays a lot. And also it becomes very far out of the money because the stock price rises in value, which would decrease the value of a put. So time goes on, and because of theta and because the underlying stock price moves upwards, because of delta, the value of the option decreases to 20 cents. Well, at this point, you might be like, what's the point? Because I have 3 months till expiration, and I have to wait 3 months for this to expire out of the money and ensure that I collect all the premium. So what's the point? Might as well buy to close it. So instead of holding on to this $100 and just running with it, which you could definitely do, you don't want to lock up all that collateral. Let's say the strike is 25. You have $2,500 locked up in collateral. You're like, well, I have $2,500 locked up just to collect an extra $20. Is that really worth it? I can make way more money with $2,500 in a different investment or selling a different cash secured put. So you decide to buy to close the position. So let's run through the credits and debits here. Initially, you collect a $100 credit, and we'll write this in premiums terms. And then to buy to close the position, because the option's worth 20 cents now, you pay a $20 debit. So your profit and loss is $80. And we'll put it in normal dollar terms now, not in premium. So you've locked in that $80 profit. You no longer have this locked up as collateral, and you can sell a new cash secured put that's maybe less out of the money and maybe the same expiration date, but you'll collect more premium. So far, this has pretty much wrapped up the entire concept of a cash secured put, although there's one more important thing we'll get to in a minute, which is called cost basis. But let's run through one more time the different possibilities when you sell to open a cash secured put. The first possibility when you sell a cash secured put is it expires out of the money. You keep your premium, and that's it. It expires out of the money. You get to keep everything. Everything's fine and dandy. The contract is dissolved. It no longer exists. You no longer have any obligations, and your collateral is freed up. In the case of assignment, you still keep your put premium. You buy 100 shares at the strike, and your collateral is used. And that's the point of having collateral, is if you are assigned, you can actually afford to buy those 100 shares. So in this case, it results in a profit. In this case, it results in a loss. But we anticipate that the underlying will increase in value, recouping losses. And this is why you want to be okay with owning the underlying, because if you're not okay with owning the underlying and you think it's going to decrease in value, well, if you get assigned, you might be stuck holding these shares or selling them for a loss because you don't want to hold them while they deteriorate in value. So you want to be okay with owning the underlying stock. Roll your position, you buy to close your current put that's in the money and sell to open a new put that's out of the money that's further out in the future for an overall credit. So you collect more premium and you will have a different collateral. And this is all to avoid assignment. So in this case, you collected more premium, but that doesn't necessarily constitute a profit and loss. You won't see that collection of premium as a profit and loss on your brokerage. So we're not going to call it a profit and loss. Although in this case, it's very good. You collected more money. It's now your cash balance has increased. The final option is buy to close. In this case, not much value left, and you want the free collateral. And in this case, it would definitely be a profit. So if you think about it, this is why cash secured puts are so awesome, is because in the first example, it's a profit. In the second example, yeah, technically it's a loss, but if you don't mind holding the shares and you think they'll definitely increase in value in the future, this is more of a profit than anything because you reduce the cost of the shares and you expect the value of the underlying to increase, which will recoup your losses and produce a profit. So really, it's not so bad of a loss. It's not like day trading and you lose $2,000 and it's gone forever. In this case, you collected more premium, so you can think of this like a profit, although it won't show it as profit and loss on your platform. And then the last position is a profit. So really all four of these, in one way or another, can be looked at as a profit. And that's why it's so awesome. Now, if you decide not to roll your position or buy to close your position and it becomes more and more and more and more in the money and you can't roll it out for a credit way out in the future because it'd just be too far in the future, you don't want to lock up your collateral for that long, you may see that the value of the option is going to increase significantly. So if you sell one for $1, you may see over time it rises up to $1,000 or $10, which is $1,000 in premium. In this case, your brokerage is going to show you a loss. You're going to have an unrealized loss of $900. This is not really valid because you collected the $100 of premium up here and that is yours as long as you are okay with being assigned. If you are okay buying 100 shares at the strike price, then maybe you're going to do so anyway if it's the current trading price and you're just going to buy those shares at the underlying at the current trading price anyway, then you're happy buying it at the strike price. You're happy you collected $100 and this loss won't matter because eventually when you get assigned, this will go away. Okay, you still get to keep your $100. You just have to buy 100 shares at the strike price. So do not panic if you see a massive loss when you're selling cash secured puts. As long as you are okay with buying the underlying at the strike price, there is no problem. That loss will disappear. Although you will end up with an unrealized loss when you own the shares, probably a pretty significant one. That's okay if you think the underlying stock will increase in value. So keep that in mind and do not panic if you're okay with owning at the strike price. There's nothing to be afraid of. This loss will not become realized. Okay, so these are the 4 possible outcomes, I think, when it comes to cash secured puts. And we'll talk about how we can combine this with covered calls to create the rolling strategy, which is a real juicy premium collecting strategy. But we have one more thing to cover, which is cost basis. So actually, I think we'll discuss cost basis when we start discussing the wheel strategy, because that's when it's really, really important to keep track of your cost basis, is when trading the wheel strategy or trading covered calls. But if you feel like you're going to be doing this on a certain underlying quite a bit, and maybe you're going to do some covered calls on it too, I would keep track of your credits and debits for your trades, as well as the cost of shares if you do get assigned. And to do so, there is a spreadsheet down below I made for you. It's not very complicated. It's pretty straightforward. Just fill in your credits and your debits. And if you do get assigned, enter how much you paid for those shares. That'll keep track of your cost basis for a cash secured put up until you get assigned. Now, keeping track of this is most important because we'll be discussing how to combine this with covered calls in the wheel strategy, where you definitely will need to know your cost basis. If it doesn't make sense, it's okay. Just punch the numbers in there whenever you do a trade. Okay, it'll become handy later when you do covered calls and cash secured puts combined as the wheel strategy. I almost forgot. We're going to do an actual trade so you can see me do it. So we're going to sell one on Snap. Okay, we don't mind Snap. Snap's a cheap underlying, so the collateral we'll have to have aside is going to be fairly low. So let's go to trade options. And we're going to do one that's not super far out, because if we have to roll our position, we don't have to roll it super far out. If I chose one that's way out in April and then it becomes in the money and I'm scared it's going to stay in the money and it's getting deeper in the money, well, I don't want to have to roll it out to January of not this year, but the following year. That's way too far out. And then my collateral's held up forever. So really, you want to do it probably 30 to 45 days out, because it'll make rolling your position easier. And also, theta starts to really ramp up. So the value of those options will start decreasing quite quickly. And if you ever want to buy to close, that's a good thing, because then you'll have to pay less to buy to close the position. So we're going to do one that's 30 to 45 days out. It is September 29th. So let's do like October 16th. That seems all right. And we want to sell one that's a little bit out of the money. Before I do, though, I want you to look at my cash balance. My cash balance is $3,533.51. And I'll make sure you remember that here in a moment, because this is where we will see the premium get deposited. So we're going to go to Snap again, and we're going to go to a put, and we don't own this put. This is a put we do not own. We're about to write it. We're writing a cash secured put. So we're going to sell one that's a little bit out of the money. So let's say we don't mind owning Snap if it drops down to $25. Let's say that's a really nice entry price. If it does drop that far, great. We wanted the shares anyway. If it doesn't, we get to collect the premium, so it's no big deal. We don't feel like we missed out. So let's sell the 25 put for a premium of 70 cents. So today we will collect $70. So we'll tap on it. We'll hit 1 to say that we're going to sell one put contract, and then we can enter the limit order. Another tip for the limit order, just to remind you, if we're going to sell to open immediately, we have to sell for cheap. So remember that. If you want to sell to somebody immediately, they're going to want to buy it for cheap. So you have to sell at the bid price. If you want to set a limit order for a higher price, that's fine, but the value of the put option will have to rise to meet you up there for you to get a fill. A good place to start is right in the middle. If there is a mid price for this one, the bid ask is so tight, it's only a penny wide. So I'm going to enter it for 70 and see if the price changes, and maybe we'll get a fill here. But if you wanted an immediate fill, you'd do 69 cents. Generally, though, it might be better just to wait a minute. So we're going to do a minimum credit of $70. And you can see our collateral there at the bottom is $2,500. That is because the strike is 25. If we were assigned, we had to buy 100 shares at the strike price, we would pay $2,500 for those shares. So Robinhood is taking $2,500 from me and setting it aside as collateral in case it gets assigned. So that those funds will not be able to be used for any other trades in case I do get assigned. So we're going to go ahead and send the sucker off. Now, if we go to our home screen, there it is. We see that put sell, and see how it says minus 70? That's what I was talking about. That's the value of the contract. As that decreases in value, we'll see that our profit increases. As that increases in value, we'll see that we'll start incurring a loss. However, as long as we never buy to close, that number does not really matter to us. We may buy to close, and that might be fine if we're rolling our position or if we've made a healthy profit. But if we never buy to close, that money, that number is meaningless. It means nothing to us because we keep that premium regardless of if it expires out of the money or if we get assigned. So if I go up here to my buying power, you can see that the money has been held aside as collateral, and I'll show the math on the screen here so you can see, but we have collected $70 in buying power, and we can cash that out however we want to be. Of course, our collateral is gone. It's tied up in the trade, but we did collect $70. So once this trade is over, once we buy to close or if it expires out of the money, that collateral will get released to us, and we'll have both the $70 and the $2,500 in our possession. But you did not lose that $2,500. It's still there, and if you get assigned, it'll be used to buy those shares, and that's not a big deal if we don't mind owning them. Let's run through an example of rolling this position. So let's say this put isn't in the money, but let's say it is in the money, just for an example. And we want to roll it out. So we want to buy to close this put for $70, and we want to sell to open a new put in the future with a lower strike for a higher value. So we collect a credit larger than the debit we pay. So what I would do is I'd tap on the put, I'd hit trade, and then view all options. We're going to go to the put we initially sold, which is the 25 strike put, and you can see that by the -1 indicated right next to it. In the top right, to select multiple options, we're going to tap select. And we are going to buy to close this 25 strike put, and we're going to sell a new one. So we're going to tap on sell now, and we want to sell one out in the future. Let's do one in November 20th. Here we can sell the 24 strike put for $165. So just to recap here, you can see how we're buying the 25 put for $70, and we're selling the 24 put for $164. This 24 strike put, even though it's more out of the money, is worth more because there's more time value built into the premium. There's more extrinsic value, and that value will decay off over time. So this put will also have a higher theta. So this is what rolling your position looks like. We're buying the snap put for $69 so far. It's changed in value. And then we're selling the 24 strike put, which is more out of the money, that expires a month later, for an extra $100 or so. So you can see at the bottom, we want to make sure that it says credit and not total debit. We want to receive a credit when rolling our position. So total credit is 94 cents. We hit review, and we're going to do one. We'll do $94 to try to get a fill here. There we go. We got a fill, and our collateral is going to be lower because the strike is 24. So instead of $2,500 in collateral, we're going to have $100 released because they only want $2,400 in collateral. So now on our home screen, you can see that our old put has been replaced by a new put with a further out expiration for a lower strike, and we've collected more premium. So that's what it looks like to roll your position. And to determine if it's a reasonable amount of premium you're collecting for how much collateral is being held up, think of it as a percentage return on investment over time. So far we've collected $165. The amount of collateral we have held up is $2,400. So let's divide that by 2,400. So we're making almost 7% return on our collateral over the next 2 months. I would say a 7% return on any amount of money over 2 months is a good return. A way to give yourself an edge when you trade cash secured puts is to find underlyings whose options have high implied volatility, whose options prices are inflated. In fact, you'll find options prices are very inflated before earnings and then suddenly drop right after earnings. And that's good for you because if you sell a cash secured put right before earnings and with an expiration shortly thereafter, you'll find that you'll sell to open for a large amount of money, and then after earnings, you can buy to close for not that much. So overnight, because of that IV crush where implied volatility drops and the options premiums collapse, you can overnight make quite a bit of money and buy to close your position quite quickly and move on to a new cash secured put or a different strategy or whatever. So find underlyings. So if you find underlyings that have high implied volatility or underlyings you don't mind owning that have earnings soon, that might be a good underlying to sell a cash secured put on. So as for now, I'm going to let the snap put stay here, and I'll either wait till expiration to let it expire, or maybe I'll roll it, or maybe it'll get in the money and I'll get assigned. But whatever happens, I don't care because cash secured puts are the tits. I hope you can find this appealing because out of all 4 outcomes that we discussed, there's not really one that's bad. There might be one that's a little more preferable, depending on what you want out of the strategy, but there's not really one distinct outcome that's negative. So that's what makes the strategy so appealing and so great. It's literally one of the best strategies out there, right up there with covered calls, and it's meant for everybody. If you have any questions, ask them in the comments. I answer questions that are written well and have not already been answered by the video. So if you have a question that you feel hasn't been answered and you're capable of writing it coherently, please ask in the comments. I will reply. One last thing. These guys, Project M Motors, they found an Instagram account that was impersonating me. And so in return, I'm shouting out their business. They are Project M Motors in Paterson, New Jersey, but they ship BMW parts worldwide. And they also focus on BMW engine rebuilds if you're in the area. So if you are a car guy, you have a BMW, you want some parts, whatever, you just want to show some love to a business during this kind of tough time, you can check out these guys' Instagram and Facebook page in the description below. So shout out to these guys for finding the douche who's pretending to be me. Although, you can't really blame them. Oh, that's a father's love.